Welcome to our session on will containerships from feeders to mega vessels continue to see high earnings? It's definitely the area that's being watched by the whole world at this moment in time. We have a wonderful discussion ahead of us today. Our moderator, Mr. Hoyoon Nam, partner of Seward and Kissel. On our panel, we have Mr. Zhao, Executive Director of CMB Financial Leasing, Michael Fitzgerald, Deputy Chief Financial Officer of OOCL, and Mr. Steve Saxon, partner of McKinsey and Company. Just before we go into the discussion, Steve is going to give us a few introductory slides. And with that, I'd like Steve to pass over to you. Thank you.
Great. Thank you very much, Kevin. And thank you to everyone for the invitation to be back at Marine Money again. I look forward to this being in person as soon as we can. I'm Steve. I'm a partner with McKinsey. I'm based in Shenzhen, China, the major export port. And my phone has been going crazy for the last couple of months with teams around the world asking, why are the container rates so high? What's going to happen and what should I be doing? You'll get lots of insights from the panelists, but I wanted to just set the scene first with a little bit of the fact base. So the question we've been asked to discuss, will container ships continue to see high earnings? First of all, let's put this in context. What are the high earnings and how have these compared to what we've seen in the past? This chart looks at return on capital, which is our preferred metric for looking at the shipping industry. Shipping is asset intensive, and as an investor into shipping, you should be thinking about the return on the capital deployed within the business. Container shipping has been famous for not returning its cost of capital. The dotted line on this chart shows you WACC, the weighted cost of capital. And you'll notice that for the last 10 years, the container shipping industry overall, blended, did not return its cost of capital. There was a lot of value destroyed for the owners of the container liners. Times before that did have some good spikes, like there were capacity shortages through the 2000s after China's entry to the WTO. So it got up, return on capital got up to 20%. We're now seeing 30% plus, and this is the Q1 numbers. The Q2 look even healthier than this. And so it is true that container lines are seeing the highest earnings that they have ever seen. Now, many would argue that the high earnings now, if you look at the area under this chart, it doesn't quite compensate for the losses yet over the last few years. So yes, while as an industry we're the container liners are making a lot of money at the moment, they've also lost a lot of money in the past few years. However, obviously, if rates continue at today's high levels and returns continue at today's high levels, this is going to be one of the best returning industries globally. So what's the cause of these super high returns on capital? It's that the freight rates have surged. The cost base of liners has actually even gone up slightly as the fuel price has gone up. So this is not a cost story. This is entirely a revenue story. This chart shows you the Shanghai freight index across different trades. And this actually underrepresents the spot rates on many of these trades. The SCFI doesn't always include all the surcharges and is sometimes slower to respond. It used to cost on average, let's say around $2,000 to shift a 40-foot container. Rates are as high as $15,000 or more for spot rates at the moment. So a truly dramatic shift in rates. What's caused that? Well, it's not a global demand boom. This chart looks at the container growth rates from CTS over the last couple of years. And we benchmark everything versus 2019. Global container growth is around 5% up over where it was in 2019. 5% should be something the industry was perfectly well able to handle through maybe a few new ships arriving, sailing a bit faster, increasing utilization. So 5% global growth shouldn't be causing the spike that we're seeing now. So what is causing it? First of all, we are seeing a demand boom on some particular trades. If you look at the top right here, you see North American import growth being around 15% up with the CTS statistics. And then if you look at some of the key ports, in particular the Los Angeles Long Beach port, you're seeing volumes up to 40% higher than they were. So there is a demand boom on North America. What's caused that? Well, American consumers during the pandemic, most of them have not lost their jobs. And all that money they used to go and spend on traveling, restaurants, poodle parlors, and nail salons has gone into spending on stuff. Americans have rushed out and bought second homes, RVs, home improvement equipment, gardening equipment, all of which is produced in Asia, and we have therefore seen a demand boom on the North American trades. But the biggest culprit here is supply. This is an analysis we did on how much container ships are actually moving on any particular day. So we say, okay, did a container ship move faster than 7.5 knots during the day? If so, we count it. And this looks at the capacity deployed. You saw capacity taken out of the industry early when COVID first hit, because I think everyone was worried that this was going to be a global recession. It became fairly quickly that consumer behavior was shifting away from services towards goods. And so by September 2020, all the container ships were deployed again. Since then, the effective capacity has come down by 13% from our analysis. And it's not because carriers don't want to sail the ships. Carriers are sailing anything they possibly can. It's because of congestion issues. What's been the causes of congestion? First of all, North American ports have become clogged. I think as we speak, there are over 50 container ships waiting outside the ports of LA and Long Beach for a berthing slot. The US ports and also the US hinterland infrastructure, so the railroads, the trucking, is just not able to cope with the demand spike which we're seeing on the North American trades. And that leads to congestion in the terminals, which leads to congestion on the ships. There's also COVID-19 outbreaks in terminals. Just up the road from here in the port of Yantian closed down for 2 or 3 weeks totally. Recently, we had a terminal in Ningbo, China, closed down because of a COVID outbreak. It's not just a China story. In other terminals around the world, longshoremen, port workers have caught COVID, and maybe some of their colleagues have needed to quarantine as well. So we have had restrictions in capacity due to COVID. And then you see the little spike down here, which was the famous ship stuck sideways across the Suez Canal. That increased congestion on the European trades. In a normal year, we'd have got past that in a few weeks. But given that everything was already under stress, we're still seeing the challenges from that Suez closure today. So with that, I want to hand to Hoyoon, who's going to talk about the panel. So in summary, this is clearly the exceptional results for the container lines, and also similarly an exceptionally bad, challenging period for the shippers themselves. It's not caused by a global demand boom. There are enough ships in the world to transport all the cargo wanting to move if supply chains were smooth again. The challenge is effective capacity has come out because of congestion. With that, I'll hand to Hoyoon, and you can hear from the real experts on the panel.
Thanks, Steve, for that wonderful introduction. That sets us up nicely for our discussion. The container shipping sector really is the talk of the town at the moment. Perhaps we can delve a bit deeper into why it's been so dramatic for the container shipping sector this past 12 months or so. Maybe we start with you, Michael. Obviously, a lot of this is simply economics 101 at play. There's excess demand that can't be satisfied by supply. I was reading an article, the CEO of a major liner company jokingly said that all ships that can float are being deployed at the moment, and that shows how competitive it is to get tonnage. Michael, how's that experience been for OOCL, and how do you plan on going about increasing your capacity?
That's right. I mean, pretty much every ship that people can find is at work on the ocean. And as well as that, every box that people can find is at work, either in the ocean or on its way to or from the ocean. Capacity is at maximum deployment. There is nothing spare that could conceivably be injected into the system. So, from that perspective, all the shipping companies are doing as much as they can to meet the demand that is out there. And I think it's fair to say that Steve's summary is pretty accurate. Really, this is not about a global demand boom. Yes, demand is very strong in the US, but it's just okay in most other places. It's not really driven by that. It's driven by what's happened in terms of effective supply. All those ships are there, but a lot of them are not doing anything. The 50 of them that are sitting outside Los Angeles and Long Beach is a great example. But there are similar congestion points that come and go, and as soon as one is solved, another one crops up in another part of the world. And container shipping is, we talk about individual trade lanes and one being better than the other, but container shipping is one interconnected system. And as soon as you have a blockage somewhere that lasts for any amount of time, it will have a knock-on effect all around the network. So for the past year or so, yes, of course, the freight rate environment has been very strong, and clearly that's had a positive impact on the P&L and the balance sheet of the whole industry. But operationally, it's been hugely intensive. This is a very, very complicated situation to handle. Not enough capacity to handle all the bookings we want to take, especially from our committed customers. Not enough boxes in the right places at the right time. All these things are common, I would say, to all players in the liner shipping industry. It's been really, really complicated, and you do have to manage it in the best way you can. And looking forward, obviously we want to do our best here. We want to serve our customers as much as we can, and that that also means accepting the complicated situation as it is. But I don't think anybody really believes that there are many windows in which this situation could slow down or materially change. I think industry consensus would say by about Chinese New Year. Maybe you could say it's a few weeks before, a few weeks after, but by around that time would be the first time at which we might conceivably start to see any kind of change in the situation, and we'll adapt to that if and when it comes.
Do you own ships as well as charter?
So we own roughly 70% of our capacity. We own pretty much all of our large vessels, and we charter in only the smaller vessels, Panamax size and smaller. That gives us the flexibility to upscale, downscale, particularly on inter-Asia routes. But basically, we own all of our large capacity.
What factors go into your consideration between owning versus chartering vessels?
Number one, there is no liquid market for large vessels to charter them in. You simply can't. Even in different times in the market, I can't call up anybody and say, please, would you charter me a 16,000, a 21,000? That market does not exist. It does exist for 1,000, 2,000, 3,000, 4,000. It's extremely liquid. So there's that consideration. But the other consideration is, these are assets, the large ships, that we will own for 20, 25 years. If we have the resources to buy it ourselves and fund it ourselves, we will do, simply because it's far cheaper to do it that way.
So speaking of the supply side of things, Yang, here's a question for you. How's the financing landscape for container ships? I know CMB has been involved with some recent financing transactions for major liner companies.
Yes, I think we mainly focusing on finance the new building ships this year, because I think the financing are all happening in the first half this year. That is only because the asset price has been appreciating too much within the past 8 months. We just see the figures from the market reports that about 1 year ago, a 4,250 TEU ships, comparing with current value, is just 1/3 of this current value. And if we're going to compare with 6 months ago, and the asset price now has doubled again. So if for financing the second-hand ships, it's very hard to evaluate the ship, and the other reason is that because liners is now insufficient liquid situation, so they had a lot of cash in hand. I don't think they need us to finance the second-hand ship when they are going to buy a ship in the market, and there's not many second-hand ships on purchasing market, I see. But for the new build ships, because before March this year, we see that the new build price is relatively fair and low comparing with what we order today. So and also normally for leasing, in a leasing structure, we finance a container vessel for long periods, like 10 to 15 years. So we did several transactions in first half this year with either the major liner companies and the tonnage providers.
Thank you. What about industry consolidation? Coming back to you, Michael, again, I know OOCL has gone through a merger not long ago. How much do you think industry consolidation has played a role in the current rate environment?
I think it's hugely important, but more important in terms of the analysis of what comes next. So, the questions are in order, how long does this market last? And then, you're going to normalize, but normalize into what? And I think a key part of that consideration is the consolidation that's happened. And this has happened incredibly quickly. From 2015-16, you've reduced from a top 20 league table down to a league table of perhaps the top 7 or 8. And even within that, it's kind of divided into two parts. Ourselves, part of the Costco group, Maersk, MSC, CMA, and then you've got another group which are a little bit behind. So that's a radically different position to what you saw 5, 6, 7 years ago. And what does that mean? I think it means that we've made a huge step forward as an industry from a context that was extremely fragmented, could hardly be more fragmented. And it's not totally consolidated. There's more things that could potentially happen, but it's a lot more healthy as an environment for rational responses to changes in the industry. And I think I have to give credit to Lars Jensen for this remark. But if you look back to what happened at the financial crisis, when demand completely collapsed, it took the industry 3 months to do anything about it. When that happened in 2020, when COVID started, it took 1 week. And I think you see there one very strong example of the fruits of consolidation. There is no more scope to be, the crazy guy who is on the far left, far right of the field, trying to do nothing but create, to gain market share. That is not, something that we see right now. And I do think consolidation deserves, a large part of the credit for that. And I do think also another sign of the positive impact of consolidation is the size of the order book. People might say the size of the order book has come up a lot in the last 6 or 7 months, and that's certainly true. But compared to where it was 10 years ago, the last time container shipping had a boom, is really more than manageable. It's now 22, 23% of the current fleet. 10 years ago, it was 60%. And that just shows you a huge difference. And I would put some of that down to the more rational behavior you see as a result of consolidation. The industry is still competitive, but I think it's much more rational.
Steve, would you agree with that? Talking about the order book, do you think we're gonna see an oversupply of ships, say 18 months from now, or do you think it'll be different this time? As Michael says, are we going to see more discipline in the industry?
So I agree with Michael that the rate environment is fundamentally changed by how consolidated the industry now is. In terms of the long-term projections of demand, roughly in line with GDP is probably where it's at. So the 5% growth we've seen over the last couple of years globally is a reasonable assumption going forward. So the order books, which continue to expand by the day, do therefore look large. And we are probably going to move back towards certainly no lack of supply shortage. However, does that mean that the rates plummet all the way back down to the levels that they once were? Probably not. And this goes to the nature of the industry. Now, equally, rates can't stay $10,000 a box or more. I think everyone realizes that that situation is unsustainable. Supernormal profits are okay in the short term while there is a real mismatch of supply and demand, but that's not a sustainable situation going forward. It would attract new entrants, it would attract regulatory scrutiny, and I think a reasonable assumption would be that rates stabilize in the long term at a level which enables container lines to make good, healthy profits, but not the levels we're seeing today.
Speaking of new orders, Yan, for those members in the audience perhaps looking for financings on new vessels, how do you choose projects, container ships or otherwise?
I think firstly we're still looking on the asset price because when we offer finance solution to our clients, leverage is the most important one. For the liners, we believe that they're quite strong in that with their balance sheet now. So for this year, we do not see any potential possibilities for us to finance more ships within the remaining 3 to 4 months. And for the other elements, we're mainly looking at is the counterparty credit. Probably, if there's suitable chance, I think the financiers may prefer to have lower leverage financing with a smaller original liner companies or tonnage providers, I think.
Thank you. Let's talk about port congestion a little bit. I guess coming back to you again, Yang, there was a port shutdown in Ningbo in China because of a positive COVID case. Do you think this will now become the new normal? We're going to see port shutdowns due to COVID or otherwise, and the industry will just have to deal with that new reality? Is there something that can be done?
I don't think it will become a new normal. However, I think the local company authorities will try their best to give their solutions to this sporadic cases. I do see that the COVID break has some of course a very big effect on the efficiency of the port distribution. So far, I think while the measures are taken seriously by the local government, I think there won't be more port closure because a single case break.
Thank you. Coming back to you, Michael, shippers, your customers, really seem to be in a tough spot. Things have gotten so bad that companies are resorting to airplanes or chartering ships directly. What can the industry do about helping out these customers, increasing their shipping capacity, at least in the medium term, and at the same time keeping rates at a reasonable level?
Yeah, I mean, I think the underlying challenge is the one we talked about, Steve talked about at the beginning. It's that there is an imbalance between the level of effective supply and the demand that's out there, and there is only so much that can be done because none of us can conjure up extra ships or extra boxes or even extra planes overnight. But the way we've tried to deal with it is to focus as much as possible on honoring our commitments to our customers. We do have a lot of contracts and long-standing contract customers, and we'll try to prioritize them as much as possible. It is an operational challenge to do that because the schedule reliability is moving around all the time because of these delays and operational difficulties. But we've also, benefited a lot from our cooperation with COSCO. Being part of that larger group, we've been able to take extra space on COSCO ships or to run extra loaders. Additional services along with COSCO. We've also laid on direct train services that have run from Xi'an in China through to Kaliningrad on the Baltic Sea, and then moving across to northern Germany and connecting from there to our transatlantic services, which provides another route to the US for customers who are a bit worried about the levels of congestion that you see on the West Coast in the US. So it's certainly a challenge. There is only so much anybody can do right now just because of that balance between effective supply and demand. But we're trying to do as much as we can. And that brings it back to what I said. Yes, it's very nice to point to the P&L, et cetera, at the moment, but the operational intensity of managing the situation is really, very, very high. And it will continue to be so. And we'll do our best to honor all our commitments to our customers as we handle the situation going forward.
Talking about the demand side, and Steve, you've mentioned that this is only a small part of the equation. Do you think a return to normalcy, whatever that may mean, will change consumer behavior and there will be less demand for goods?
Excellent question. So let's focus on the US market, because that's the one where there really has been a demand shift. The US economy continues to do really well. And therefore, I think we were asked the question, so will spending shift back from goods back towards services? I think our answer is no, people are going to spend on both goods and services because kind of savings are higher. But the economy is doing well. We still see healthy demand for imports. And in the short term, you've got lots of restocking, like the retailers, the US importers can't get their hands on the capacity they want. So at least through till the end of this year, we also see restocking. Now, the challenge comes in the medium term, as you talked about, kind of what's the longer term view on this. The US does have some fundamental bottlenecks around the port capacity, which it needs to work through. Now, some of that can be done with additional shifts, additional labour, but some of it is fundamental as well. There just needs to be more infrastructure in the US. So if we continue to see the level of demand growth we have, there are going to continue to be delays on the North American services.
Believe it or not, we're nearing our 3 o'clock mark here. So just continuing with that theme, Yang, what do you think is the biggest challenge that the container shipping industry faces today? And how do you think that'll play out as the world starts to figure out how to live with COVID?
Yeah, I think for now, the port congestion and the efficiency of the shipping and distribution is definitely the most important reason causing the higher rates for the lining business. Will this become new normal for the container logistic? I think if there are, because the delivery of the new build ships will intensively happen in 2022 and 23 and thereafter. If there are vessels delivery in the next 2-3 years, but the efficiency of port operation and distribution system inland do not improve, I think it will probably cause more waiting time for the ships when they are discharging or loading cargo. While there could be more vessels, the ultimate solution still will be the efficiency of the port and the inland distribution facility.
Michael, what keeps you up at night?
I think it's the pace at which the transition into the next stage will happen. I think we would share the view of quite a few of the industry experts and analysts who think it's not going to be a sudden change. It's going to be something that happens reasonably gradually, perhaps in 2 stages. I think that's the thing we're trying to think forward to, and how to address that challenge next year. But I would say, though, in terms of supply side growth, I think, yes, there are plenty of ships coming in 2023. And if you look at the order book, certainly it's come up and it's quite much bigger than it was. Let's put it that way. But looking forward into 2023, first of all, there's the operational challenge that Mr. Yang just talked about, but also there are a whole load of environmental rules that could well impact the effective capacity levels. Perhaps not so much affecting 2023, but certainly affecting every year thereafter. A midlife and older vessels, a lot of them may have to go more slowly. That is a big mitigant against the increase on the supply side through new ships. So I think it's a balanced picture, but managing that transition is certainly something that we're trying to think forward to and how to handle it.
Steve, anything to add to the challenges of the container shipping industry?
I think the big question is, what does the next phase look like? Because clearly what the situation at the moment is not great for the shippers. They can't get their hands on the capacity. They're paying rates which in many cases makes the business unviable. And when I talk to container executives, sometimes they smile about the profits they're making. The next moment, they really are not happy about the service they're delivering to long-term customers. And the reliability, the on-time performance is a huge challenge. What's going to change this? I think, first of all, shippers are going to look again at supply chains. The reliance on just-in-time supply from Asia, clearly container shipping has shown itself that it's not as reliable as people thought that it was. Rates are not going to stabilize at the level they previously were. It's going to be maybe 50% higher. And that will change people's decisions about sourcing. It's not easy to shift sourcing on a 1 month, 2 month time frame, but on a 1 year, 2 year time frame, it is. So it will encourage more diversification of supply chains and in some cases more nearshoring and local manufacturing. And the last thing I'd highlight is the relationship between the carriers and the shippers. If you look over time, the carriers and shippers have had agreements, but they're not firm contracts. They're what's called rate agreements. It's not binding on either side. In times of short supply, the carriers will say, look, we'll do our best, but we can't guarantee you space at that price. Equally, when the shippers are not giving their minimum guaranteed quantities, the liners were not enforcing any penalty payments. So shipping has lacked enforceable contracts. And I do think that we're going to see a shift in contracting in the industry towards more longer-term contracts with binding commitments on each side, where shippers will pay for a guarantee of a certain level of capacity, but in return, they will guarantee a certain level of volume. And that should lead to a more stable industry in terms of returns for everyone and more predictability for the shippers.
Well, thank you all for your wonderful insights. I think our time is up. I really do hope that we can see each other in person, perhaps next year at this conference. I guess I'll hand it back to you, Kevin.
Yeah, thank you very much, Hoyoon. Thanks for a great discussion. Of course, we're going through a fantastic phase in container shipping, so there are a lot of exciting things to talk about. Likewise, we hope that when we meet again next year, we'll all be in person. So, Hoyoon, as a moderator, and to each of the panelists, thank you very much.
Thank you.
Thank you.